CSX Q2, 2026. EPS of 54 cents, up 23% year over year. Revenue at $3.94 billion, up 10%. Full-year guidance projecting mid to high single-digit revenue growth, operating margins expanding over 350 basis points, CapEx capped under $2.4 billion, and free cash flow growth rocketing past 80%.
I mean, it's just a staggering release. The numbers are flashing green in almost every single category.
Yeah, shares are actively popping in after-hours trading as the market digests the print.
And honestly, the market reaction reflects just how unexpected the magnitude of this operating leverage really was, right?
Yeah.
Especially given the macro environment.
Exactly. If you're a retail investor, you should be staring at those headline numbers in absolute disbelief.
Oh, totally.
I mean, a 23% jump in earnings on just a 10% bump in revenue. We're looking at a 190-year-old, asset-heavy, slow-moving legacy railroad
Right.
that is suddenly posting margin expansions that look more like, Silicon Valley software company in a recovery quarter.
It's wild, but that's exactly why we're digging into it.
Right. Today, we are looking under the hood of the CSX Q2 2026 earnings report and the management presentation. Our mission here is to figure out how they are driving this massive operating leverage.
Yeah, and more importantly, whether these macro tailwinds are sustainable for the second half of the year, or if this is just a perfect storm of cyclical gifts.
Because when a mature Class I railroad puts up these kinds of growth multiples, you cannot just look at the top line.
No, not at all. You have to dissect the margins, and the mechanics of their profitability this quarter are really fascinating.
Let's pull apart that margin miracle right now then. Operating income hit $1.51 billion. That is a 17% jump.
Huge.
Yeah, and the operating margin expanded by 240 basis points to reach 38.3%. But here is the kicker, the piece of data that should make any financial analyst pause.
The fuel costs.
Yes. They achieved this margin expansion despite a massive 160 basis point headwind from fuel prices. Locomotive fuel expense spiked 74% year over year.
Right.
That added $177 million in pure variable costs to the balance sheet.
And, a 74% spike in your primary variable commodity cost is normally a death knell for margin expansion.
It really is.
I mean, railroads consume hundreds of millions of gallons of diesel. Usually, when spot prices for fuel spike that violently, the fuel surcharge programs they have with customers, well, they lag by a quarter or two.
Right. They can't pass it on immediately.
Exactly. You end up eating that cost in the immediate term, and your margins just get compressed. But CSX essentially insulated their bottom line by running a ruthlessly tight ship everywhere else. Total non-fuel expenses actually dropped by 2%.
Which is crazy when you think about the scale of their operations.
Yeah.
Running a railroad is, it's a lot like running a massive luxury hotel.
Oh, that's a good way to put it.
Right. Your fixed costs, building the structure, paying the staff, keeping the lights on are astronomical. But once those fixed costs are covered, renting out one empty room costs you almost nothing. For a Class I railroad, it's just a giant physical operating leverage machine.
That is the perfect analogy. In railroading, you have to maintain thousands of miles of track, the terminals, the switching yards, the signal systems.
All the heavy infrastructure.
Exactly. But once that network is operational and the crew is paid for the route, the physical cost of hooking up one extra boxcar to, a 2-mile-long train is incredibly low.
Right. The fuel increase is fractions of a penny. The crew cost is zero.
Yes. By actively driving down those non-fuel expenses, CSX ensured that the incremental revenue from that 10% top-line growth fell almost entirely straight to the bottom line.
Okay, but I want to look closely at how they drove down those non-fuel expenses, specifically the labor. Because as a retail investor, I read these labor numbers and I get nervous.
How so?
Well, the rail industry narrowly avoided a catastrophic national strike a few years ago over grueling schedules and understaffing. So when I look at the balance sheet and see they saved $48 million from a lower overall headcount.
You think they're juicing the number?
Right. My immediate fear is that they're just working a smaller workforce significantly harder to juice this quarter's margins. I mean, they paid out $56 million more in incentive comp. Right. So is that sustainable? Tell me why I shouldn't be worried about a union walkout.
It is a totally valid fear, honestly. Labor tension is a structural risk in the sector. But looking at the granular data, I don't think sweating a skeleton crew is the accurate diagnosis here.
Okay.
It's really more about the underlying physics of a fluid network.
What do you mean by fluid network?
So when a railroad network is fluid, it means trains aren't sitting idle in yards. Switches are happening on time. Bottlenecks are cleared before they cascade.
Everything is just flowing.
Right, flowing smoothly. And when that happens, you naturally need fewer crews sitting around waiting. You aren't paying crews to sit in a hotel room in Chicago for 3 days, waiting for a delayed train to arrive.
Ah, I see.
And you have fewer crews timing out on their federally mandated shift limits out in the middle of nowhere, which, forces you to dispatch a second crew in a van just to relieve them.
Which is incredibly expensive.
Exactly. Fewer delays mean less overtime, fewer penalty payments, and a naturally lower headcount requirement to move the exact same amount of freight.
That makes a lot of sense.
And we can see this reflected in the incentive compensation. You mentioned their incentive comp went up by $56 million this quarter. That is purely driven by higher expected performance payouts. Management and operators hit their operational targets.
Okay, so the $48 million saved on headcount isn't from firing the people they need. It's the financial byproduct of a network that simply isn't gummed up.
Spot on.
And we also see that in purchase services and other expenses, which fell by $66 million. Management actually noted that $54 million of that drop came directly from efficiency savings across operating functions.
Yeah, they're really tightening the belt operationally.
But, efficiency on the cost side doesn't matter much if the volume isn't there to actually push through the network.
Right, you need stuff to move.
To understand how revenue jumped 10% to $3.94 billion, we have to look inside the boxcars. Overall, volume grew by 6%, hitting 1.68 million units.
The segment breakdown here is where the macro story really intersects with CSX's micro-execution. And the undeniable star of this quarter was intermodal.
Oh, absolutely.
Huh.
Intermodal volume was up 9%, but the revenue didn't just track volume. Revenue spiked a massive 26% to $620 million.
Yeah. For anyone not tracking the logistics jargon daily, intermodal is when you move freight in those large steel shipping containers.
The ones you see stacked on ships.
Exactly. The container gets lifted off a cargo ship, placed directly onto a rail car, and then eventually lifted onto a truck chassis for the final few miles. The cargo inside never gets unpacked during the journey.
Right. Management pointed to a tightening truck environment and active rail conversions as the primary drivers there.
Because intermodal is like the ultimate barometer for domestic freight health. What we're seeing in the data is that rail is actively stealing market share back from trucking.
Which is a big shift.
It is. Truck supply is tightening significantly across the country. At the same time, we have this massive sustained push in infrastructure spending coupled with the nationwide build-out of data centers.
With all the heavy materials.
Right. Those mega projects require heavy bulk materials. When truck capacity gets tight, spot rates skyrocket. Suddenly, it becomes much too expensive to ship by 18-wheeler, and shippers look to rail to absorb the overflow. CSX was positioned perfectly to catch that volume.
Okay, I see the macro logic, but let me challenge that narrative for a second.
Go for it.
If intermodal's 26% revenue spike is heavily tied to a tight truck market, isn't that just a cyclical macro gift rather than a sticky operational win for CSX?
That's the billion-dollar question right there.
Right, because what happens when truck capacity inevitably loosens up again? Are these rail conversions really sticky? Or are they just fair weather friends who will jump right back to highway trucking the minute diesel drops and truck spot rates cool off?
Yeah, that dictates the long-term multiple of this stock. Historically, yes, a lot of that volume would bleed back to trucks the moment the cycle turned. Trucking is inherently more flexible.
Exactly.
But CSX is actively trying to change that dynamic through service reliability. If a railroad can prove to a shipper that they can deliver on time, consistently, without damaging the goods, the massive cost advantage of rail becomes incredibly sticky.
Okay, so it's about proving their worth during this window.
Right. That is why the new service offerings management highlighted on the call are so critical. They are trying to prove to these new customers that rail isn't just a temporary marriage of convenience during a truck shortage. It is a structural supply chain upgrade.
That's a good point.
Yeah.
Let's pivot to the merchandise segment, which is really the steady, kind of unglamorous engine of the whole operation.
The C engine, yeah.
Volume was up 4%, revenue up 8% to $2.446 billion. The subcategories are pretty telling. Chemicals grew 8%, driven by plastics, sand, and pet coke. Agriculture and food grew 2%. Minerals were up 6%.
When you look at those merchandise numbers, you aren't just learning about CSX. You're looking at a real-time proxy for the U.S. manufacturing base.
Oh, for sure.
If you hold construction or industrial stocks in your portfolio, say, Caterpillar or Vulcan Materials, this CSX print is flashing a giant green light for the broader economy.
Right, because the 8% growth in chemicals especially plastics and frac sand, ties directly back to industrial output and energy.
Exactly. And minerals being up 6% is pure commercial construction and infrastructure demand.
But it wasn't a clean sweep across the board. The laggards were auto and forest products. Auto volume was down 1%. Management noted this was due to temporary customer plant retooling outages. And forest products were essentially flat.
Yeah, lumber gains were offset by pulp and paper customer outages,
Right.
Which tells you that the weakness there is idiosyncratic, not systemic. A plant retooling is a temporary blip. It's a factory upgrading its line, not a destruction of underlying consumer demand for cars.
Right. Once those auto plants spin back up, that volume returns to the rail network.
Exactly.
And then there is coal. Volume up 4%, revenue up 9% to $520 million. But the underlying dynamic here is a tale of two entirely different markets. Export coal is incredibly strong right now due to mine restarts in the Curtis Bay facility. But that export strength is actively masking a continuous drop in domestic utility coal shipments.
The secular decline of domestic thermal coal, the coal used to generate electricity, is well documented and irreversible. Utilities are retiring coal plants in favor of natural gas and renewables.
Yeah, that ship has sailed.
But the global demand for metallurgical coal, which is the specific type of coal required to forge steel, remains highly robust. And CSX has fantastic physical access to the East Coast export terminals to serve that global market.
So they have a structural geographic advantage.
Right. It extends the life cycle of their coal segment significantly, even as domestic power plants shut down.
I'll also briefly note their trucking segment revenue ticked up to $226 million, though management cautioned that was mostly just riding on fuel surcharges rather than massive volume expansion.
Yeah, mostly a pricing thing.
So we've seen the volumes and we've seen the margins. But as any seasoned rail investor knows, pushing more volume through a fixed physical network is historically a recipe for congestion, delays, and, accidents.
Yeah, more volume equals more stress on the physical system. It's a really delicate balancing act.
Right. So are management's operational metrics actually holding up under the weight of a 6% volume increase? CEO Steve Angel spent a lot of time on the call highlighting their ability to manage this growth without losing focus on safety.
And the numbers actually back him up.
We really do. The FRA Personal Injury Index improved 19% to 0.83. Even more impressive, the train accident rate improved by an incredible 30% to 2.72.
Which is huge. Those aren't just feel-good ESG metrics to put in an annual report. They are leading indicators of financial health for a railroad.
Because accidents are incredibly expensive.
Right. An accident or a derailment doesn't just cost money in environmental cleanup and damaged freight. It paralyzes the network. It freezes your assets. A main line might be shut down for days, forcing you to reroute trains hundreds of miles out of the way. Wow.
So a 30% improvement in the accident rate is a massive financial shield against unexpected operational costs.
And that fluidity shows up directly in their velocity metrics. Terminal dwell time, which is literally just how long a train sits in a rail yard doing nothing, dropped 4% to 9.4 hours. Gross ton miles per employee rose 6%. This marks a fourth straight quarter of year-over-year improvement.
This brings us right back to our earlier debate about the workforce and how they're achieving these efficiencies.
Let's talk about the how, actually. How does terminal dwell time drop to 9.4 hours? Management brought up the modernization of the Radnor Yard in Nashville as a prime example, specifically highlighting the installation of power-operated switches.
Yeah, this is such a great detail.
For anyone not familiar with rail yard physics, normally a 2-mile-long train has to grind to a halt when changing tracks. A conductor has to physically climb down from the locomotive, walk hundreds of yards in the gravel, manually pull a heavy steel lever to switch the track, walk back, and climb up. A power switch is done remotely from a control tower. Think about the compounding math on that. You just saved maybe 15 or 20 minutes of idle time. Multiply that 20 minutes by hundreds of switches a day across a major hub like Nashville.
That adds up fast.
Exactly. And you suddenly understand exactly how terminal dwell time drops by 4%.
And when dwell time drops, asset utilization goes up, meaning your CapEx goes further.
Precisely. You don't need to buy as many new locomotives if the ones you currently have are constantly moving. You don't need to hire as many crews. That is how you generate real operating leverage.
And we can literally see that lack of required spending in the cash flow statement. Because they aren't forced to buy new locomotives to compensate for a sluggish network, their capital allocation is aggressively shareholder-friendly. Year-to-date free cash flow is robust at $1.617 billion.
That's a massive number.
And they're returning that cash directly to you. They've returned $1.038 billion to shareholders so far this year. It is split almost evenly, with $518 million in share buybacks and $520 million in dividends. Plus, that includes an 8% dividend hike they pushed through earlier in the year.
It's a phenomenal yield strategy. But what stands out to me is that they're doing this while maintaining strict discipline on CapEx, keeping it capped under $2.4 billion for the year.
Right.
They aren't starving the business to fund the buybacks. They are actively investing in targeted growth and safety, like those power switches at Radnor Yard.
And corporate customers are clearly noticing. Diageo just opened a massive 360,000 square foot facility on a CSX Select site in Alabama.
That Diageo facility is the perfect example of sticky volume. When a massive corporation builds a 360,000 square foot facility physically attached to your specific rail network, that is not cyclical volume that will jump to a trucking company for a 5-cent per mile discount.
No way.
That is a decades-long revenue stream locked in.
It really paints a picture of a company cementing its physical footprint, which might be why Time just named CSX one of America's 250 most iconic companies.
Yeah.
But I have to ask you, as an investor, do you worry that a label like iconic company is just polite media speak for a mature, slow-growth legacy business?
That's a fair, cynical view.
Right, like, is being iconic actually a red flag that their high-growth days are behind them?
In tech, iconic often just means old. But in the context of a Class I railroad, being a legacy business means you possess a physical monopoly that can never, ever be replicated. You couldn't build the CSX network today for $1 trillion.
Oh, the land rights alone.
The land rights, the zoning approvals, the environmental impact studies. It would be impossible in 2026 to lay thousands of miles of continuous new track across the eastern United States.
Good point.
So yes, it is mature and it is a legacy business. But that iconic status represents an impenetrable economic moat. No startup is going to disrupt the physical reality of moving 10,000 tons of steel. When they operate that moat efficiently, like we were seeing with the 9.4-hour dwell times and the 38.3% operating margins, that slow-growth legacy business becomes an absolute cash-printing machine.
Which perfectly sets up our forward-looking view for the second half of 2026. We have the Q2 results, we see the cash being generated, but as retail investors, we have to keep our eyes on the horizon. Management noted specific headwinds in their 2H commercial outlook. They called out inventory normalization and anticipated plant turnarounds that might slow momentum in both the automotive and chemical sectors.
And that's the necessary reality check. You cannot extrapolate Q2's perfect margin conditions in a straight line forever. Inventory normalization has a very specific physical reality for freight velocity.
Right.
During supply chain panics, companies hoard materials, meaning they ship everything as fast as possible. Normalization means customers finally feel their supply chains are secure enough that they don't need to hoard. They buy only what they need just in time. That naturally slows down the overall velocity of freight demand.
But let's leave you, the listener, with a final investment framing to ponder as you digest this earnings report. CSX just managed to expand their operating margins by 240 basis points, all while swallowing a staggering 74% spike in locomotive fuel prices. So if we look out to the next few quarters, and diesel prices simply normalize back to their historical averages, what is the true ceiling on this company's free cash flow generation? Is the modern, optimized rail industry structurally more profitable than anyone currently realizes?
If the efficiency holds when the fuel pressure drops, the upside could truly be historic.
Make sure you follow the show for our daily earnings coverage, keeping you ahead of the numbers.